Whew, it's sunny. This is another episode of Tax Talk in Traffic. I have my autopilot on. We're good to go. My name's Fook. I've been doing taxes in Santa Clara for about 15 years or so. Today I'm going to talk about car mileage for business owners, and this really relates to the real estate agents, the consultants, and photographers, videographers, anyone that drives a lot for business and they use their personal car to get to places that they need to get to for work. So the first thing you need to know about deducting mileage for work is there are two ways to deduct mileage. The first way is called the standard mileage rate, and then the second way is called the actual method. So what we're gonna have to do, we're gonna have to actually do some math here and calculate which method is actually better for each person, because not one method is always better for everyone. So sometimes taking the standard rate is better, sometimes taking the actual is better. And it really depends on your situation, but we're gonna have to do some math there. For both methods, you're still gonna have to track the number of miles driven for business and the total mileage driven in all. That means business plus personal. And with the rule with taking mileage is that you're allowed to take the higher of the two between the two methods. The first thing I'm going to discuss is a standard mileage rate. And what this is that it allows you to deduct a certain amount for each mile that you drive. So say Lisa, she drove a certain amount of miles, let's say 10,000 miles all year. And of that 10,000 miles, 5,000 went to business use. So what you take is 5,000 times the allowable amount that the IRS allows. And for 2019, it's going to be 58 cents. So if she drove 5,000 miles times 58 cents, that's this total. And that's how much she gets to deduct. The second method is the actual expense method, where you still have to track the number of business miles versus the number of total miles. And what we have to do is take that ratio. So let's just say, for example, Lisa's business mileage portion is 5,000 miles, but her total mileage for business and personal is 10,000. So that means half of it went to business. So when you take actual expenses, that means we're going to take half of her gas, insurance, lease payments or depreciation of the car, and other associated costs of the vehicle. So let's say these are her cost of maintaining the vehicle, and this is the total that she would get to deduct if she took the actual mileage. As you can see in this example right here, taking the actual is going to be more beneficial because you get a higher deduction versus the standard mileage rate. So let's do another example for the actual where we take out the lease payment. Let's just say she doesn't have a lease payment, where she just has she bought a used car a few years ago and she's just using that for her new consulting work. So if we take out the lease payments, you'll see that running the same calculation where 50% of the car uses for business versus the standard mileage rate, is that the standard mileage rate is going to be better this time. So a little tip is that for both actual and standard mileage rate, either one you get to deduct the parking and tolls that you pay, no matter which method you take, because that's separate from the actual maintenance of the car. And also for each one, if you finance a car, the interest that you pay to finance the car is deductible on either standard or actual. So in general, there are certain situations that will fit way more in the standard versus the actual. So for example, if you drive like a hybrid car where you're not spending much on gas, maybe it's an older car as well, so your insurance is pretty low, and then maybe there's not much maintenance on that car either, maybe just a general oil change and that's really it, there's no major repairs, probably taking the standard mileage rate will be better for that situation. Now for a future video, I'm also going to talk about whether you should purchase or lease a car for businesses, and I get this question a lot, so look for that in my next video. The key to making sure you're getting the most deduction out of your car expenses and driving your car is to run both calculations, because you always want to take the higher of the two. One caveat though, if it's your first year of taking a car expense and you choose standard mileage rate, that means you could switch back and forth every year from standard or actual expenses, meaning that if maybe the first year it's better to take standard and in the second year it's better to take actual, then you could switch. But if the first year you're using actual, you have to stick with it for the rest of the car's life. So sometimes I tell clients that it's still better to take the standard mileage rate for the first year, just to give us the option to jump back and forth in case we needed to. If you do any business with Lyft, Uber, or Turo, make sure you're tracking your mileage on that especially. So from what I understand for Uber and Lyft, they only track the mileage that you actually drive when the passenger is in your car, but they don't tell you the mileage when you're actually driving to the passenger, or maybe if you're just driving around looking for passengers, they don't track that. So you need to be able to track those because those are considered business mileage. Even if there's no one in your car, as long as you're trying to look for business at the time, you are considered driving for business. So here are some tips when it comes to tracking your mileage, is that you have to track your mileage because the IRS knows that people don't track their mileage because it's such a tedious task that it's one of the first things they ask for in an audit. So when it comes to keeping track of mileage, you can't just write the number of miles down and say, oh, I drove 15 miles and that's it. IRS is going to want to scrutinize what you are trying to deduct. So for the mileage log, you have to keep a few things. It's number of miles driven, where you're going, what the driving is for, and the date that you are driving. Remember, with the IRS, you are guilty until proven innocent. Now, I've attended IRS audits where they don't accept an Excel sheet calculation, even if you provide all the details. But I've also had an audit where the agent did accept it. So I guess it really depends on the agent. Maybe if they're more on the older side, they probably won't accept an Excel sheet. They probably want like a mileage log. So just keep that in mind. Maybe having like a Google Calendar is best because that way you could write down where you're going, how many miles, and then you already have the dates on when you're driving. So for example, today, January 3rd, I am driving to San Jose to meet with my client to talk about tax planning. And I drove 15 miles. So that you'd have to cover all of those bases. Now, just keeping track of your mileage is not enough for the IRS. They're still going to ask for more information because they want you to prove that you actually drove a certain amount of miles during the year. And the way to try to make you prove this is that they're going to ask you for some kind of like repair bill or smog check bill or tire bill that shows your odometer reading from a third party source, meaning that if you got an oil change, the mechanic should have written your odometer on the receipt. So they're going to want to see a receipt for early in the year, like January, and some kind of other repair sheet for December. And then they're going to say, okay, did you really drive that many miles from January to December? And that's another way they try to prove you wrong in an audit. So make sure that you keep track of not only the mileage log, but also keep those car receipts because you're going to need it. Even if you're taking standard mileage rate, they want to see, did you really drive the number of miles that you said that you drove? And the way to determine that is by looking at your car maintenance receipts. Remember that with an IRS audit, the burden of proof is on you as a taxpayer, and you are guilty before proven innocent. So hope you like this video. Share it, like it, subscribe, and all these other things that other YouTubers say when they want people to watch more of their videos. I'll be doing another video on purchasing versus leasing a car, so keep an eye out on that.